Hello everyone, welcome to Akira's Academy of Accounting and Finance, and in this second part we are going to discuss about interest on drawings. I know it's bit tricky and bit confusing, but don't worry, the main thing is what you need to understand is the logic, and that is what I am here to make you understand. Now in the first part we discussed about this capital amount, how to calculate the interest on capital. That was very easy for you to understand, right? There's a capital amount, you charge the rate of interest for how many period month you have to give, for that months you have to consider it. Okay, now similarly, when the partner is withdrawing, what are drawings? Partner withdrawing certain amount from the firm for its personal use. Now obviously it is partner's firm and he can withdraw, but at the end of the year, right? Now if he withdraws or if he asks for a certain amount from some other banks or financial institution, obviously they are also going to charge interest on that. Or else if the firm gives somebody money, the firm is going to charge interest on that person. Similarly, when the firm is giving certain amount to the partners are also supposed to give interest on that particular amount. The thing is how to calculate the interest amount. If the partner has withdrawn the amount like once in a while, then it's easy to calculate. What you need to do, it's a simple method that we know, that you know the amount of the drawing, the rate of interest, multiply by the months, like how much of period is remaining, and that for that period you have to charge the interest. Let's say he withdraw 1 lakh rupees. Okay, amount of drawing is 1 lakh rupees. Now the rate of interest is, let's say, 10%. Okay, so the rate of interest 10%, and he withdraws the amount on 1st of October. Okay, so he will be charged interest for how many months? October, November, December, January, February and March, for 6 months. So for 6 months the interest will be how much? 10% of 1 lakh is 10,000, and half of it, that is 5,000. So 5,000 will be the interest amount that will be charged from the partners. Now it's not necessary that partner withdraw only once or twice. There are multiple times the partner is withdrawing. Now that drawings could be at a regular interval or an irregular interval. Moreover, it could be like a fixed amount or a varying amount, right? So it becomes difficult to calculate, it's become difficult to calculate this in this simple method. Like say if he has withdrawn for 10 times, all the times calculating. So to simplify it, there are two methods which we are going to understand how to calculate the rate of interest on that. Okay, not the rate, the interest amount. So the first method is the product method, and the another one is the average period method. Now why there is such difference? Because in this method, what is there is varying amounts the partner is withdrawing. Okay, there is no such fixed amount. Sometimes he withdraw 5,000, sometimes 15,000, like that. And that interval, it is not regular. Sometimes he will withdraw in the month of April, sometimes by the end of March, sometimes in the middle of this October month, like that he withdraws the amount, right? Whereas in this way, in this method, what is it? He is withdrawing a fixed amount every time. He is withdrawing the fixed amount. Moreover, the second condition to apply this average period method is he is withdrawing at a regular interval, maybe monthly, quarterly, half yearly, first half of the year, second half of the year, whatever it is, it's on a regular interval. So there are two methods to simplify when such situations are being given. So let's understand when he is withdrawing varying amounts at a irregular intervals. Okay, varying amounts, let's take an example. He withdraw first 5,000 rupees, then he withdraws 12,000 rupees, 5,000 on 1st April, right? Then 12,000 he withdraws on 31st of July. Then he withdraw 24,000 in the month of December, 1st December, right? Then he withdraws, let's say, 3,600 on 28th of Feb, and then he withdraws 10,000 on 31st of March. This is how he was withdrawing the amount. The partner was withdrawing the amount. The amounts are varying, they are not fixed, they are not the same. Different point of time, different amount he is withdrawing from the firm. So if we go by simple method, I'll just show you how we will do it. So if we go by simple method, how we will calculate the rate of interest? 5,000. Okay, this is the amount of withdrawn. Rate of interest 10 by 100, and he withdraws in the month of April. So we will charge interest for the whole year, right? So into 12 by 12, that is for the whole year. So here it is 500. Next, he withdraw the amount on 31st of July. Okay, so how many months? First on 12,000 at the rate of 10% on 31st of July, means July has ended. August, September, October, November, December, January, February, March, 8 months. Okay, so we have to charge interest for 8 months. How much it will be? 12,000, so 800. Okay, the next amount he withdraws 24,000 on, this is for 8 months, right? I'm writing the months over here. He withdraws 24,000 on 1st of December. So for how many months we will charge interest? December, January, February and March. So for 4 months. Okay, for 4 months. 112, 212, 2 4s are 8. 800 rupees will be the rate of interest. So here we will write for 4 months. Next, he is withdrawing 3,600 on 28th of Feb. Okay, the Feb month is over. Then he is withdrawing the amount. So we will charge interest only for 1 month, 10%. For 1 month, this is for 1 month. So it will be how much? 112, 312. Oh, 30. And the last amount he has withdrawn 10,000, 10% into 31st of March. The year has ended, so we are not supposed to charge interest on that amount. So it's 0 into 0, it will be nil. So the total interest amount will be how much? 500 plus 8, 13. 13 plus 8 is 21, 2130. Okay, 16. Sorry, 8, 5, 13, 14, 15, 16, 17, 18, 19, 20, 21. So, now, 2130. Okay. So, now, like this is just the 5 withdrawings I have taken. Okay. And you have to calculate separately. Instead of that, what is the easy way to calculate? Here the denominators are same. 12, 12, 12, 12. The denominators are same. We are not going to do anything with the denominators. What we are going to do? We will multiply this. 5,000 into 12. 12,000 into 8. 24,000. The denominators are same. We are going to keep the denominator as such. We will multiply the amount of withdrawings into the period of months, okay, remaining after the drawings. What we will get? 12, 5, 60. 12, 8 are 96,000. 24, 4s are 4 4s are 16. 2, 4, 8, 96,000. Okay. 3,600, and here into 0 will be 0. So 60,000 plus 96,000 plus 96 plus 33,600. It is how much? 2,55,600. Okay, this is what we have considered. Okay, this is the total product, the withdrawings multiplied with the months remaining. Okay, months remaining for the interest to be charged. So now we will calculate the interest as per the product method. What is the formula? Interest on drawing, we will consider the total product into rate upon 100, that is rate of interest, into 1 by 12, because here the denominator is same. We have not divided anything, we had just multiplied it. Okay, so we will divide it by 12. Okay, so what is the total product? 2,55,600. Rate of interest is 10% to 1 by 12. So 255,600, 10% of that divided by 12, it's how much? 2130. Okay, understood? the amount is same. It's the easy way to do. Simple method, obviously it's become very much cumbersome, so to simplify it, we will apply the product method when there is a varying amount at an irregular intervals. Okay, now comes the point when there is a fixed amount. Okay, he is withdrawing fixed amount, let's say 1000 every month he is withdrawing. Okay, so fixed amount, and he is withdrawing at a regular interval, means monthly, quarterly, half yearly, first half of the year or second half of the year. And that too, even if he is withdrawing monthly, the criteria is regular interval. There is a regular interval, the gap is same. Monthly, maybe in the beginning of month, so every month in the first date he is withdrawing the amount, or in the middle on the 15th date of every month he is withdrawing the amount, or on the end of the month, that is on the end, like the 30th of the date he is withdrawing the amount. Okay, may it be quarterly, may it be half yearly, there could be a beginning of the quarter, middle of the quarter, end of the quarter. So in this case also we can apply the product method. That is not an issue. You will find the simple method, product method, both the things will apply over here. But obviously the average period method is more easy when you will calculate a fixed amount at a regular interval. What is the average period method say? How to calculate interest on drawings on that? This is interest on drawing equal to total drawings. Total drawings into the rate of interest, that is rate upon 100, into the average period. We need to find out the average period and divided by 12. Like for 12 months, this is the rate of this is the interest we will charge. For the average period, how much? So how to calculate? It's easy to calculate the average period. If we calculate like this, like the drawings are same every month, if we consider the average of this, let's say on 1st April he is withdrawing 1st May, so 12 months is the remaining. Okay, for the interest, we'll charge interest for 12 months. Then for 1st of May, 11 months we will charge interest. Similarly, if we calculate all these things, if we add it up, it will be 78, and the average of this is 6.5. This is the average period. Okay, now to simplify, what is being said? Consider the first month when he has withdrawn the amount, how much months are remaining after the first drawing, and how many months are remaining after the last drawing. Okay, this is 12 plus 1 divided by 2, that is 13 divided by 2 equals to 6.5. Okay, easy. Like, what is the formula for average period? It is drawings after the first month remaining after the first drawing plus the last drawings. Okay, month remaining after the last drawing divided by 2, you will get the average period. If we consider this, if we start calculating this, obviously it will be more tiresome. What you need to do, maybe let's say middle of the month. Middle of the month means every 15th date of the month. If we say 15th of April, that means how much months are remaining? From May till March, 11 months plus 15 days of April means half of the month. So we will charge interest for 11.5 months, then 10.5 months, 9.5 months. But if we just consider this, the first drawing and the last drawing, how many months are there? 11.5 plus 0.5 divided by 2, that is 12 divided by 2 equals to 6. We will get the average period. No need to go for this average period method. Oh, no need to go for this calculation. Okay, just need to consider the first month. Okay, how many months are remaining after the first drawing and how many months are remaining after the last drawing. If he is withdrawing at the end of every month, let's say end of every month, like say 30th of April, how many months? 11 months. End of the last month is which? March, 31st March, so 0 month remaining after that. Okay, so 11 plus 0 divided by 2 equals to 5.5, and we will be easily able to calculate the average period. Okay, let's take an example. Let's say if he is withdrawing every month 1000 rupees. Every month he is withdrawing 1000 rupees at the beginning of the month. How we will calculate? Total drawings will be how much? Monthly he is withdrawing 1000, so for 12 months he is withdrawing 12,000 rupees. Okay, the rate of interest is, let's say, 10%, and on the beginning of every month he is withdrawing. So the first drawing, months after the first drawing plus months after the last drawing, average of that is how much? 6.5. so 6.5 divided by 12, this is the rate of interest for the whole year. So how much will be for 6.5 months? Okay, what we will get? 12,000, 112, 60, 650. Okay, this is how we are going to get the interest on drawing when there is a fixed amount at a regular interval. Similarly, like if we considered quarterly, if he is withdrawing the amount quarterly, how to consider? How many quarters are there? 4 quarters, like April, May, June, July, August, September, October, November, December, January, February and March. These are the 4 quarters in a year. Okay, now let's say if he is withdrawing quarterly in the beginning of each quarter. Beginning of each quarter means on 1st of April, 1st of June, 1st of October, 1st of January. So how many months remaining when he is withdrawing on 1st of April? 12, June 9, October 6 months and January 3 months. Total of this is how much? 30. We took out the average of these 4, it is 7.5. Instead of this, what you need to do? How you will calculate the average period? When is the first drawing? How many months are there after the first drawing? 12. And how many months are there after the last drawing? 3. Divided by 2, 12 by plus 3 is how much? 15. 15 divided by 2 is 7.5. We got the average period. Okay, it's as easy as that. If it's in the middle, first middle means what? In the month of May. Okay, and middle of May, that is 15th of May, right? 15th of May. Now how to calculate? Middle of the quarter, it is said. Okay, middle of the quarter. So first quarter's middle is 15th of May, second quarter's middle is 15th of August, 15th of November and 15th of February. Like that the partner is withdrawing. So how we will calculate the months? He has to pay interest for 10 months. Okay, June, July, August, September, October, November, December, January, February, March, 10 plus half of the month, 15th of May, 15 days still remaining. So half of the month, that is 10.5, then 7.5, 4.5, 1.5, 1.5, like 1st of 15th of Feb. Okay, so March full month plus 15 days remaining in Feb. 13 days, but we are taking out the average. He is withdrawing, let's say 14th or 13th. Okay, so half of the Feb month, so 1.5, so 10.5 plus 1.5 divided by 2, 12 divided by 2 equals to 6. Easy. Okay, similarly when we say end of the quarter means 30th of June, 30th of September, 31st of December, 31st of March, end of the quarter. So when he withdraws end of the quarter, he has to give interest for the 9 months. Okay, when he withdraws end of September, he has to give interest for the 6 months. End of December, he has to give interest for 3 months, and end of March he is not supposed to give any interest. So how we will get to the average period? 9 the first month plus 0 divided by 2. 9 divided by 2 is 4.5. okay, that's how we will calculate. Half yearly, there are 2 conditions, half yearly and half of the year. Half yearly means there are the half of the year, right? April, May, June, July, August, September, 6 months, and then October, November, December, January, February, March, remaining 6 months. That is also being done in 3 parts. Okay, it could be in the beginning of the half yearly, it could be middle of the half yearly, or it could be end of the half yearly. When I say beginning of the half year, that means in the month of April. Okay, so 12 months, and then in the month of October, 6 months remaining, 18 divided by 2, 9. It's easy, right? When I say middle of the half year is what? April, May, June, October, November, December. So it could be here 30th of June or 1st of July. 30th of June or 1st of July, and in the second half year it could be 31st of December or 1st of January. After that, in this, if 30th of June is there, how many months are remaining? 9 months. And if he withdraws on 31st of December or 1st of January, he has to pay interest for 3 months. 9 plus 3 is 12. 12 by 2 is 6. And if he withdraws at the end of the half year, at the end of the half year means in the month of September, 30th of September, or else on 1st of October, he has to pay interest for half of the year. 6 plus 0, 6 divided by 3 is 3. If he withdraws on 31st of March, end of the half year, 31st March, no interest. So 6 plus 0, that is 6 divided by 3 is, 6 divided by 2 is 3. Now there could be first half of the year or second half of the year. That means partner is withdrawing the amount for first half of the year, like for the first 6 months only he is withdrawing the amounts, right? So for the first 6 months means April to September, he is withdrawing the amount. April to September, so for that period only he is supposed to pay interest. When he is withdrawing on 1st of April, he has to pay interest for 12 months, and when he is withdrawing on 1st of September, August, September, 12, 11, 10, 9, 8 and 7. Okay, 1st of September, so for the month of September and the remaining 6 months, so 12 plus 7, the total of it is 57 by 6 divided, it's 9.5. And if we consider 12 plus 7 divided by 2, 19 divided by 2 is 9.5. Similarly, if he considers in the middle of the every month for first half of the year, we get the first drawings 11.5 and the last drawing 6.5 months remaining. Like he is withdrawing on 15th of September, so 6.5, 6 months from October to March plus half of the month for the month of September. So 11.5 plus 6.5 is 18 divided by 2, it's 9. Okay, similarly at the end of the month for the first half of the year, end of the month means 31st of April, 30th of May, 30th of June, 30th of April, 31st of May, 30th of June, 31st of July, 31st of August and 31st of September. So for the first, at the end, so for the first month it will be 11. For the end of September it will be 6 months. So 11 plus 6 is how much? 17 by 2, it will be 8.5. Okay, same situation could be for the second half of the year. Second half of the year, the amount, the period will change because it is for the remaining 6 months. Remaining 6 months, first beginning of every month, first month, like first date of October, 6 months, then 5 months, 4 months, 3 months, 2 months, 1 month. Average is 21 by 6 of all these is 3.5. Instead 6 plus 1, that is 7 divided by 2 is also 3.5. Middle of the second half of the year, middle of the second half, when he is drawing for the first time, he is withdrawing on 15th of October, so he has to pay interest for 5.5 months, and he is middle of the March, that is 0.5. 6 divided by 2 is 3. Okay, and in this case end of the year, that is on 31st of October till 31st of March. 31st of October he'll pay interest for 5 months, plus 31st of March he's not supposed to pay interest. So 5 plus 0 divided by 2, that is 2.5. This is how you will get the average period. I have explained the average period of monthly, quarterly, half yearly, first half of the year and second half of the year. I don't think so any more situation could be there. Like there could be a situation in practical world, but for your exam this is the maximum they can ask you. Okay, and this is how you will get to know the average of monthly, quarterly, half yearly and first half of the year and second half of the year. If you know the average period, the rest is easy. The total drawings, remember total drawings. If it is said that monthly he is withdrawing 10,000, so for 12 months, you have to consider. If quarterly, so for 4 quarters you need to consider. Okay, that is how you are supposed to consider the amount. Okay, there are chances you could make a mistake. Don't make mistake over here, then the whole, okay, you'll be at a loss. So the average period, the total drawings, you just have to apply this formula and it's very easy to calculate. Okay, now there could be a case wherein it is not mentioned in the question, like the partner has withdrawn a certain amount during the year. Okay, let's say he has withdrawn 1,20,000 during the year, and you have to charge interest at the rate of 10% per annum. In that case, what we will consider the average period? We have to assume that he has taken out the amount in the middle of the month over a period of these 12 months. Over the year, every month at the middle of the month he has withdrawn the amount. So for that we have to consider 6, okay, as the average period. So for in this case, how it will be? 1,20,000, 10 by 100 into 6 by 12. So 10% of 120 is 12,000, and half of it, that is 6,000. So in that case, the interest on drawing will be 6,000 rupees. If nothing has been mentioned, you have to consider average period as 6 months. I hope you got this interest on drawings. Just understand the logic behind it, and it's very easy to calculate. In the next part, I am going to discuss the remaining 2 points, that is past adjustment and guarantee of profit to the partner. I hope you got it. See you in the next part. Thank you very much.